On January 30th, 2026, silver did something that breaks the way most people think markets are supposed to behave. In a single session, the price action was described as nearly a 30% drop, not months, not weeks, in one day. And then, in the next 48 hours, the physical side of that same market started acting like the metal had become harder to get, not easier. Lead times that had been closer to 2 or 3 weeks a month earlier were suddenly being talked about as 8 to 10 weeks for new sovereign mint orders. Here's the impossibility claim. Embedded in that contradiction, if price is the signal that balances supply and demand, a crash should instantly loosen supply. Dealers should be flush, premiums should compress, delivery should speed up. Instead, the reports coming from the dealer and wholesale layer sounded like the opposite. Record physical demand, tightening inventory, and delays that don't care what the chart says. And this is the part that changes everything about how you read a week like this. Institutions already know where the stress lives, and it's not always on the screen. The stress lives in the plumbing. Borrowing costs, delivery windows, vault movements, and the spread between what's promised on paper and what's available for immediate shipment. When those signals diverge, the headline price becomes a lagging indicator of something deeper. Welcome to Market Signal Desk. This is where we decode the numbers before the crowd turns them into a story. If you like analysis that follows filings, vault data, and dealer behavior instead of vibes, consider subscribing the way you'd keep listening to that calm elder who's seen a few cycles. And tell me in the comments where you're watching from, because this market behaves differently depending on whether you're close to the physical supply chain or far from it. Now, let's reconstruct what actually happened, with a kind of forensic detail that makes the mystery visible. The first layer is the shock itself. A near 30% move in a day is not normal for a mature, globally traded commodity. Even in volatile periods, that kind of move compresses time. It forces risk managers to react, it forces leverage positions to reevaluate, and it forces dealers to reassess what they can quote and what they can actually source. And when a price drops that fast, it doesn't just change sentiment. It changes collateral. It changes margin math. It changes whether someone can carry inventory through the next trading session without a forced decision. Within days of that January 30th move, the conversation wasn't just about price. It was about availability and the cost of immediacy. Dealers were not describing a world where supply suddenly flooded in. They were describing a world where people who had been waiting decided the dip was their window, and where the pipeline couldn't instantly respond. The phrase record physical demand matters because it implies something simple. The paper price moved down faster than the physical market could replenish. Then comes the second layer, premiums and retail reality. At one point in the public discussion, silver was described as trading above $90 an ounce. And a specific retail example was cited where American Silver Eagle premiums were around $8 per ounce. If spot is 90 and the premium is 8, the buyer isn't experiencing 90. They're experiencing something closer to 98 before taxes and shipping. That spread is not a footnote. That spread is the market speaking in two languages at once. One for paper liquidity, one for physical immediacy. And now we get to the central mystery. How can a market suffer a violent paper repricing and simultaneously show signs of physical tightness? How can the chart scream cheap while the dealer network whispers scarce? To answer that, you have to stop thinking of silver as one market. It's multiple markets stitched together. Futures contracts, unallocated accounts, allocated bars, retail coins, industrial demand, refinery throughput, shipping capacity, and the credit system that finances inventory. When one layer moves, the others don't always move in sync. And when they don't, the gap is where the story lives. This is not the first time we've seen this playbook. The pattern is old and it keeps repeating because the structure of the market keeps repeating. In 1980, the silver market became a symbol of squeeze psychology and leverage stress. The details are complex, but the takeaway is simple. When a concentrated rush meets exchange risk controls, the market can move violently and then snap in ways that hurt anyone who thought the price was the whole truth. The aftermath wasn't just about who was right or wrong. It was about how liquidity can vanish when the rules of financing change. In 2011, silver experienced a dramatic run and then a sharp reversal. The lesson there wasn't only about exuberance. It was about how quickly a leveraged paper market can reverse when margin requirements shift and risk appetite changes. When the cost to hold a position rises, forced selling can appear even if the underlying narrative hasn't changed. The market can punish timing without disproving the broader conditions. In 2020, something different happened, but the rhyme was unmistakable. A global shock disrupted supply chains, and even when spot prices moved, the retail and wholesale physical market told its own story. Premiums widened, delivery windows stretched. People learned in real time that a screen quote and an available coin are not the same product. Now in 2026, the same pattern is showing up again, but with its own fingerprints. A sudden paper shock on January 30th, followed by reports of lead times stretching to 8 to 10 weeks by February 2nd, compared with 2 to 3 weeks roughly 30 days earlier. Time is the hidden price. When delivery time explodes, the market is telling you something about capacity and scarcity that the spot chart can't express. So who is moving first when this happens? The answer is usually not the retail buyer. It's the institutions that live inside the financing layer. One of the most striking numbers discussed in recent commentary was the behavior of silver lease rates. Lease rates are a way to talk about the cost of borrowing metal. If borrowing is cheap, it implies liquidity. If borrowing becomes expensive, it implies stress. The claim that lease rates jumped from under 2% to over 100% in just days is not a small anomaly. That is a market alarm. It suggests a moment where lenders demanded extraordinary compensation, or where borrowers were desperate enough to pay it, or both. Why does that matter? Because the modern precious metals pipeline relies on borrowing and lending to keep inventory moving. Dealers hedge, refineries schedule, wholesalers finance stock. If the cost of borrowing metal explodes, someone somewhere decides they can't operate the usual way. They pull back from buybacks, they widen spreads, they ration quotes, and suddenly the retail buyer feels it as out of stock or pre-order only, while the chart shows a neat number with 2 decimals. Now layer in the vault data, because this is where the institutional reality becomes measurable. London is one of the global centers for precious metals storage and settlement. 57% month over month. 3% move sounds tiny, but vault data isn't like a retail shelf. It's a liquidity reservoir. Small percentage changes can matter because the system's usable float can be far smaller than the headline total, depending on what is earmarked, pledged, or simply not available at the right form and location. If silver inventory in that hub edges down while borrowing costs are claimed to spike and physical lead times stretch, you don't need to believe any single narrative. You just need to recognize the alignment of stress signals. Borrowing becomes expensive. Delivery becomes slow. Premiums stay stubborn. Those are not random. This is where it gets interesting because the dislocation is not only between paper and physical, it can also appear between different paper instruments themselves. One of the more extreme points cited was a disconnect between spot and futures that widened to nearly $3 per ounce, described as backwardation. Backwardation is a word that sounds academic, but the intuition is simple. It can suggest that the market is placing a premium on immediate metal over promised future delivery. In a normal world, time costs money, so later is often priced higher. When the curve flips, the market can be telling you that now has become the scarce product. Think about what it means if the spread is nearly $3. In a world where people argue over pennies, $3 is a shout. And that is exactly the same message that 8 to 10 week lead times deliver, just in a different language. So how does this dislocation happen? It happens when one set of participants is forced to act quickly and another set can't deliver quickly. The paper market can be repriced by flows and risk controls in minutes. The physical market can't print new coins in minutes. It can't refine and ship in minutes. And it can't magically expand mint capacity in a weekend. Let's make the mechanism plain without dumbing it down. Imagine a stadium with 2 entrances. One entrance is huge and automated. People can run through it instantly. That's the paper market. The other entrance is narrow and it has security checks, metal detectors, and a manual line. That's the physical supply chain. When a crowd suddenly decides to move, the automated entrance changes the official count immediately. But the narrow entrance becomes the real experience. People don't care what the scoreboard says if they're stuck in line. In a sudden paper sell-off, some selling is voluntary, some is forced. Forced selling comes from margin and collateral dynamics. If an exchange raises margin requirements, or if brokers tighten risk limits, leveraged holders may have to post more cash or reduce exposure. That reduction becomes selling pressure, regardless of conviction. The price falls, the chart looks decisive, but the physical buyer watching that fall may interpret it as an opportunity to lock in supply, especially if they already distrust the stability of the paper system. Now add dealer behavior. Dealers manage risk by hedging in the paper market. When paper volatility explodes, hedging costs rise. Bid-ask spreads widen. Some dealers pause buybacks because they can't confidently hedge incoming metal at predictable terms. That can look to the public like dealers don't want your metal, which feels backward in a shortage. But it's not backward. It's risk management. If the hedge instrument is unstable, a dealer may prefer to conserve capital and protect inventory. Rather than take in metal they cannot price cleanly. Refineries add another constraint. Refining is throughput limited. If demand for certain forms spikes, sovereign minted coins, specific bar sizes, production can't instantly pivot. The system runs on schedules. When those schedules get overwhelmed, lead times stretch. That's not a conspiracy, that's capacity. Now connect it back to institutions. Institutions can arbitrage across layers when the plumbing is smooth. They can borrow metal at low lease rates, deliver into obligations, and roll positions. When borrowing becomes expensive, again, the claim of a jump from under 2% to triple digits is the kind of number that, if true, changes the whole incentive structure. Arbitrage becomes painful or impossible. The gap widens. This is why two markets can tell opposite stories. The paper market can be screaming sell, driven by forced de-risking, while the physical market can be screaming buy, driven by a desire for immediate, tangible supply. The gap cannot persist forever because it is an inefficiency, but it can persist long enough to punish anyone who assumes convergence is immediate. So what evidence should you watch in a week like this beyond the chart? Watch lead times. When the delivery window moves from 2 to 3 weeks to 8 to 10 weeks in about a month, that's a measurable supply signal. Watch premiums. When a well-known retail product carries an $8 premium at a time when spot is in the $90 neighborhood, that spread is telling you the real clearing price for that product form. Watch borrowing costs. When lease rates are discussed as exploding from under 2% to triple digits, that is a credit market story, not just a commodity story. None of these signals guarantee a single outcome, but together they create a map. Now, let's talk about what this means going forward without turning it into a prediction. The value here is not a target number. The value is understanding the scenarios that historically follow this kind of dislocation. If the dislocation is temporary and financing normalizes, the conservative scenario is a retightening of spreads. Lead times ease as mints and wholesalers catch up, premiums compress, and the paper market reasserts itself as the dominant price reference. In this scenario, the story becomes that was a volatility event, and the system returns to routine. If the dislocation persists, the moderate scenario is a prolonged period of two-tier pricing, paper. Volatility continues, while physical premiums remain elevated due to sustained demand and constrained throughput. The market becomes less about a single spot quote and more about availability. If the plumbing stress intensifies, the aggressive scenario is that borrowing and settlement frictions lead to sharper episodic disconnects, moments where immediate metal commands a significant premium relative to promises, and where policy and exchange adjustments become the main catalyst. In past cycles, these moments have often been accompanied by sudden rule changes, margin hikes, tighter credit, altered delivery incentives, not because someone wants drama, but because the system tries to protect itself. So what indicators make these scenarios visible in real time? First, watch whether lead times shorten or lengthen from that 8 to 10 week zone. Time is the early warning system. Second, watch whether premiums like that $8 example compress meaningfully or stay sticky even if spot moves. Sticky premiums mean physical demand is absorbing supply. Third, watch whether the spread dynamics, like a large spot versus futures gap, normalize. When urgency fades, those gaps tend to shrink. Fourth, watch vault and reported inventory trends, especially in major hubs where lending and settlement concentrate. This brings us to the human part of the story, the divide that always appears in markets like this. There are people who only see the number on the screen. And then there are people who see the network behind the number. This is not about intelligence. It's about attention. The information gap becomes a wealth gap because the first group reacts to headlines, while the second group reads the signals that generate the headlines. Institutions tend to move first because they monitor the plumbing. They notice borrowing costs before the public does. They see settlement friction before the public does. They react to margin changes and financing constraints in real time. Retail participants usually move last, not because they're wrong, but because the data reaches them filtered through narratives. By the time the story is obvious, the positioning has already happened. That's why weeks like this matter. A near 30% paper drop on January 30th, 2026 is dramatic, but the deeper story is the mismatch that followed. Stretched delivery windows by February 2nd, stubborn premiums in retail examples, claims of extreme lease rate behavior, and vault numbers that provide a backdrop of incremental change in a critical hub. Those pieces together tell you where stress might be building and where it might release. And here's the quiet conclusion. Markets don't just move on belief, they move on mechanics. Belief is loud, but mechanics are decisive. When the mechanics start contradicting the headline price, that's when the real analysis begins. To see why dealers notice stress before most people do, picture their weekly reality. A dealer doesn't just post a number. They manage inventory risk, hedging risk, and the promise of delivery. If the answer is uncertain, spreads widen, quotes get conservative, and some products move to pre-order. From the outside, it looks like premiums rising, but from the inside, it's a business trying to stay solvent in a storm. Inventory language is also more layered than it sounds. In stock can mean on the shelf, already in transit, sitting at a wholesaler, or allocated at a mint on a schedule that hasn't been updated yet. When lead times jump from 2 to 3 weeks to 8 to 10 weeks, those layers collapse fast. Shelf inventory gets cleaned out. Transit inventory is already spoken for. wholesaler inventory gets rationed. And the mint schedule becomes the bottleneck because presses and blanks don't scale on demand. At the institutional level, the same logic appears through financing. Futures and forwards aren't just speculation, they are a way to carry exposure with collateral. When exchanges and brokers respond to volatility by demanding more margin, collateral gets pulled from other uses. Some participants can post it, others reduce positions. That reduction becomes selling pressure regardless of belief. The chart can fall even while physical buyers interpret the drop as a chance to secure supply. Here's the coordination point most people miss. It doesn't take a secret meeting for behavior to look coordinated. It only takes shared constraints. Volatility rises, risk models tighten across firms, margin demands rise across clearing systems, and financing costs rise across the credit web. The timing looks synchronized because the inputs are synchronized. The paper market is dominated by participants responding to risk constraints at the speed of software. The physical market is dominated by participants responding to availability constraints at the speed of refineries, mint presses, and shipping. This is why vault reporting functions like a weather station. It doesn't cause the storm, but it tells you the pressure. 57%. Those are not dramatic percentage moves, but they matter because these hubs are tied into lending and settlement. Small changes can align with bigger signals like stretched delivery windows and elevated borrowing stress. And it's why a retail example like an $8 premium on a widely recognized sovereign coin is not just trivia. Coins have their own constraints, mint capacity, distribution, and product-specific demand. They're not interchangeable with a generic bar. When that premium stays firm, it's the market putting a price on immediacy and form. Finally, the spot versus futures gap described as nearing $3 per ounce is another way the market prices time. When time becomes expensive in multiple places, spreads, lead times, and term structure, the system is telling you liquidity is tight in the channels that matter for delivery. If you want one sentence that captures the week, it's this: the market is pricing liquidity stress, while the public is watching price stress. Liquidity stress shows up in premiums, lease rates, spreads, and delivery windows. Price stress shows up in the candle chart. Both matter, but they describe different layers. There's also a psychological paradox that repeats across decades. A sharp drop can increase demand because it reactivates a reference point. People remember the higher price and perceive the lower price as a window, especially when the asset is tangible and finite. In physical metals, that psychology is amplified by possession and delivery. And certainty has a cost. It shows up as longer delivery windows, firmer premiums, and cautious dealer quoting. That's why the week after a paper shock is often the real reveal. The chart tells you what liquid risk did. The dealer network tells you what real-world capacity can handle. When those messages disagree, the right move is observation. Watch how quickly lead times normalize, whether premiums compress, and whether borrowing stress fades or spreads today. This is Market Signal Desk, where we decode what matters before it's headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether volatility will return. The question is whether the signals will be understood before the next move forces everyone to learn them the hard way.